Most people think a bad credit score means they're bad with money, but that's not true. In fact, some people earning six figures have terrible credit scores, and some people with completely average incomes have scores above 800. Even more surprising, one simple mistake can drop your credit score by over 100 points, and millions of people make that mistake every single month without even realizing it. Now, imagine this. Two people walk into a car dealership. Same age, same job, same income, same car. One drives away paying around $350 per month. The other pays more than $500 per month. Same car, same lender. But over the next 5 years, one person pays thousands more. Why? Three numbers: their credit score. And here's the crazy part. Getting an excellent credit score is not complicated. It's not reserved for rich people. It's not reserved for financial experts. It's mostly about understanding a few simple rules that most people were never taught. In this video, I'll show you exactly how credit scores work, what affects them, the fastest ways to improve them, and the 5 mistakes that silently destroy them. And stick around until the end, because one of the easiest credit score improvements doesn't require paying off a single dollar of debt. Let's begin. Before we talk about improving your score, let's answer a simple question. What exactly is a credit score? Think of it as a trust score. It's a number lenders use to answer one question. Can this person be trusted to pay back borrowed money? The higher your score, the lower the risk you appear to lenders. And lower risk usually means better financial opportunities, lower interest rates, better credit cards, higher borrowing limits, better mortgage offers, and ultimately, more money staying in your pocket. Quick note, if you're in the United States, you'll usually hear people talk about FICO scores ranging from 300 to 850. If you're in the United Kingdom, different credit bureaus use different scales. But don't get too focused on the exact number. The goal is simple: reach the top tier, because that's where the best financial opportunities usually exist. Now, here's something many people don't realize. Your credit score isn't important because of the number itself. It's important because of what that number costs you. Imagine financing a $30,000 car. Someone with excellent credit might receive a much lower interest rate than someone with poor credit. Over the life of the loan, that difference can cost thousands of dollars, not hundreds, thousands. And when it comes to mortgages, the gap can become even larger. We're talking about tens of thousands of dollars or pounds over time. That's why improving your credit score can be one of the highest return financial moves you'll ever make. Now, here's the good news. Your credit score isn't random. It's calculated using specific factors. Think of them as 5 dials. But here's what most people get wrong. They think all 5 factors matter equally. They don't. In reality, one factor has more impact than the other 4 combined. And if you're getting this one wrong, almost nothing else matters. Let's start there. Payment history. Payment history is the single biggest factor affecting your credit score. It's very simple. Do you pay your bills on time? Every on-time payment builds trust. Every missed payment damages trust. But here's what many people underestimate. You don't have to disappear for 6 months. You don't have to miss multiple payments. In many cases, being just 30 days late can create serious damage. That's why setting up automatic payments is one of the smartest things you can do, even if it's only for the minimum payment. One missed payment can undo months of progress, and that's exactly why payment history sits at the top of the list. But if payment history is king, what's the fastest factor to improve? The answer surprises most people. Credit utilization. Credit utilization is simply the percentage of available credit you're currently using. Let's say your credit limit is $5,000. If your balance is $2,500, you're using 50% of your available credit, and that's higher than lenders like to see. A common recommendation is to stay below 30%, but people aiming for excellent scores often stay below 10%. And here's what's interesting. This is one of the few factors that can sometimes improve relatively quickly. Reduce your balances, lower your utilization, and lenders immediately see less risk. But pay attention to this. Your balance is often reported on your statement date, not your payment due date. That's a mistake many people don't realize they're making. Remember when I mentioned an easy score boost that doesn't require paying off a single dollar of debt? We're getting close. But first, let's continue. In fact, some people spend years trying to improve their score while completely ignoring the next factor. And unlike utilization, this one can't be fixed overnight. Length of credit history. Length of credit history is essentially how long you've successfully managed credit. Lenders like experience. The longer you've successfully managed credit, the safer you appear. This is why closing your oldest credit card can sometimes hurt your score, even if you never use it. That account is helping build your credit history every month. Unless there's a strong reason to close it, keeping older accounts open is often the smarter move. Next comes credit mix. This simply refers to the different types of credit you've managed. Credit cards, student loans, auto loans, mortgages. A healthy mix can help demonstrate that you're capable of handling different financial responsibilities. But don't take out loans just to improve your score. That's not the goal. The goal is responsible credit management, not borrowing money unnecessarily. New credit applications. The final factor is new credit applications. Every time you apply for new credit, lenders may perform what's called a hard inquiry. One inquiry isn't usually a big problem. 5 inquiries in a short period? Now lenders start asking questions. Too many applications can make you appear financially stressed, so apply strategically, not emotionally. Now let's talk about something practical. What if your score is already low? Or what if you barely have a credit history at all? If you have low or no credit, this happens more often than people think. Young adults, recent immigrants, people who've simply avoided credit. The challenge is frustrating. You need credit to build credit, but there are solutions. Secured credit cards, credit builder products, credit builder cards, authorized user accounts, and in some cases, simply correcting information on your credit report. The goal is not borrowing more money. The goal is creating evidence that you can use credit responsibly. Now let's get to the part most people came for, the fastest ways to improve your score. Number 1, reduce high credit card balances. If your utilization is above 30%, this is often your biggest opportunity for improvement. Number 2, request a credit limit increase. And this is the trick I mentioned earlier. Imagine you owe $2,000. Your limit is $5,000. That's 40% utilization. Now imagine the bank increases your limit to $10,000. You still owe $2,000, but now your utilization drops to 20%. Same debt, different utilization, potentially a healthier credit profile. Just make sure you don't increase your spending along with the limit. Number 3, check your credit report for errors. Incorrect information happens more often than people realize. Wrong addresses, incorrect late payments, accounts that don't belong to you. Every mistake has the potential to hurt your score, and fixing those errors can sometimes produce meaningful improvements. Number 4, avoid unnecessary credit applications. Every application should have a purpose. Don't collect credit cards simply because they're available. Number 5, keep older accounts open whenever practical. Older accounts strengthen your history. Closing them can reduce both your account age and available credit. Now let's cover the 5 mistakes that destroy credit scores, because avoiding mistakes is often easier than fixing them. If you've watched this far, pay close attention, because many people understand credit scores and still destroy them with these mistakes. Mistake number 1, missing payments. Still the fastest way to damage your score. Mistake number 2, maxing out your credit cards. Even if you eventually pay them off, high utilization creates risk in the eyes of lenders. Mistake number 3, applying for too many accounts too quickly. Mistake number 4, ignoring your credit report. You can't fix problems you never look for. And mistake number 5, believing income determines your credit score.
it doesn't. A person earning $40,000 with disciplined financial habits can have a much higher score than someone earning several times more. Credit scores measure behavior, not income. And that brings us to an important truth. People with excellent credit scores are usually not doing anything extraordinary. They're not using secret hacks. They're not gaming the system. They're simply doing the basics consistently, paying on time, keeping balances low, avoiding unnecessary debt, checking their reports occasionally, and being patient. Because credit improvement is rarely instant. But consistency compounds, and over time, those small habits create massive financial advantages. So, here's your challenge. This week, check your credit score. Not next month, not someday, this week. Know your starting point, because you can't improve what you don't measure. And remember this, an 800-plus credit score is not a reward for being wealthy. It's a reward for demonstrating consistent financial responsibility over time. And here's the interesting part. Building a great credit score is only step one. The real advantage comes from knowing how to use that score to get better loans, better credit cards, and better financial opportunities. That's exactly what we'll cover in the next video. So if you haven't subscribed yet, now's the time. Thanks for watching, and I'll see you in the next one.